All right, the Fed is about to drop its minutes, and buried deep inside all of that central banker jargon is one single word. Just one. And it can signal the market's next big move. So today, we're not just going to read the headlines. No, we're going to decode a secret language and turn it into a clear, actionable trading strategy. Let's get right into it. So here's our game plan for cracking this code. First, we're going to uncover what the Fed is really afraid of by busting a super common myth. Then, we'll learn how to read the market's dashboard just like the pros do. After that, and this is the big one, we'll reveal the asymmetry secret that is the heart of this entire strategy. We'll also see why volatility is the real villain for your portfolio, and then finally, we'll pull it all together into a simple plan you can actually use.
Okay, let's kick things off by trying to get inside the mind of the Fed, because what most people think drives the market, well, it's actually a myth, and we're about to bust it wide open.
Look, when you hear a Fed governor say they're nervous, don't just brush it off like it's small talk. It is a carefully chosen signal. I mean, in the world of central banking, where literally trillions of dollars hang on every single word, nervous is code. It's code for we're not totally sure what's going to happen next. And believe me, when the most powerful financial institution on the planet admits it's uncertain, the market listens and it usually gets volatile.
And that brings us to maybe the biggest myth in all of investing. I'm sure you've heard it a million times. High interest rates are bad for stocks. But you know what? That's not really what the data shows. The real portfolio killer, the true enemy, isn't the level of rates, it's uncertainty. It's when the market has no idea what the Fed is going to do next, when it can't predict the future with any kind of confidence, that's when portfolios really get hammered. And this quote, it just perfectly captures the difference between how amateurs and pros think about the market. Amateurs, they try to avoid every little bump in the road. Pros know that's impossible. So instead, they focus on avoiding the cliff. See, it's not about dodging every market dip. It's about making sure you're not in the portfolio when it goes completely off the rails. And that Fed-induced uncertainty, that's what creates those cliffs.
So how do we navigate all this uncertainty? Well, we need the right set of tools. Let's take a look at the secret dashboard the pros use to read the market's mind and see what it might be telling us right now.
First, just a quick reminder of the Fed's, well, let's call it an impossible job. They have to juggle these two goals, keep people employed and keep prices stable. The problem? These two goals are almost always at war with each other. Pushing for more jobs can make inflation shoot up. Fighting inflation can cost people those jobs. It's this constant tension, this tightrope walk. That's why every single word they use is so carefully chosen.
And these are the big tools in the Fed's toolbox. They can inject or suck money out of the system. They can change the overnight interest rate for banks. They can even pay banks to just sit on their cash. You can think of these as the dials and levers the Fed is constantly adjusting to steer the entire U.S. economy.
Okay, so the Fed is pulling all these levers, but how can we possibly know what the market is actually thinking? How do we get a real-time read on what the smartest investors on Wall Street are doing with their money? Well, the answer lies in two key gauges on our secret dashboard. Our first gauge is the yield curve, and really it's basically a snapshot of the market's collective gut feeling about the future of the economy. I mean, you've got bond investors betting trillions of dollars on what they think will happen years from now, so when you plot all those bets on a graph, you get this incredibly powerful forecast of what might be coming down the pike. And the best part about the yield curve is its simplicity. You don't need a PhD to read it. When it's sloping up, that's normal. The market's optimistic about growth. When it's flat, the market's getting a little nervous and uncertain. But when it inverts, when you can get paid more for a 2-year bond than a 10-year bond, that has historically been a massive flashing red light for a recession. All right, our second tool is Fed Funds Futures. Think of this as the market's own betting odds on the Fed's next move. It's like the Las Vegas line for interest rates. By watching this market, we can see exactly what the smart money is expecting in terms of future rate hikes or cuts. This is where we can spot if the market is getting the Fed's real intentions wrong. Okay, we have our tools. We've got our dashboard. Now for the secret key that unlocks everything. The most important signal from the Fed, it doesn't come from a number. Nope, it comes from a single, powerful concept that's hidden in their language. And that concept is called asymmetrical risk. In trading, it's simple. You risk a little to potentially make a lot. Well, the Fed thinks the exact same way, but their stakes are, the entire economy. They're constantly balancing the risk of runaway inflation against the risk of causing a deep recession. And their language is the key to understanding which one of those two things they're more afraid of at any given moment.
So when you're reading the Fed's minutes and you see the word symmetric, it's like they're giving the all-clear signal. They're basically saying, hey, we've got this. The risks are perfectly balanced. They feel they can keep the economy on a steady, predictable course. For the market, this is the ultimate green light to just kind of relax. But here's the secret. This is the whole shebang. The most important signal isn't what the Fed says. It's what they stop saying. When that word symmetric vanishes from their statements, that's the red flag. It means the balance has shifted. They are now officially more worried about one problem than the other. And that is your cue to get ready for some serious market volatility.
So this is it. This is the crucial point. It's the S word. You scan the Fed minutes not for what they're saying, but for what they are no longer saying. If that language of balance and symmetry is suddenly gone, that's your signal. The Fed is showing its hand. They're telling you which risk they fear most, and it is time for you to adjust your portfolio. So, we've cracked the code on the Fed's language. Awesome. Now, let's connect the dots and see what that actually means for your portfolio. Because when the Fed gets nervous, the market gets volatile, and that's when your money is really on the line.
So, meet the VIX. It's often called the fear gauge, and that is a perfect name for it. Think of it as the market's heart rate monitor. It's calculated from options prices, which are basically insurance policies against a market crash. So when the VIX is low and steady, everything's calm. But when it starts to spike, you know fear is starting to take over.
And I love this quote because it just gets to the heart of what it means to be an investor. You can't escape uncertainty. It's impossible. But you can absolutely learn to measure it. And that's exactly what the VIX allows us to do. It's our most important tool for understanding just how much fear is coursing through the market at any given moment.
So now we can see the entire chain reaction, clear as day. It all starts with that subtle clue in the language. The Fed's talk shifts away from symmetry. That signals to the market that policy is now unpredictable, which cranks up uncertainty. And that uncertainty is then measured by a spike in the VIX, as traders scramble to buy protection. It is a direct, predictable path from Fed speak to market fear.
All right, we've cracked the code and we've seen the chain reaction. Now it's time to put it all together. Let's build a simple, powerful strategy you can use to trade the next Fed announcement like a pro.
And here it is, the entire strategy on one slide. It's that simple. If the Fed is using words like symmetric or balanced risks, you can expect pretty smooth sailing. The yield curve will probably be stable, the VIX will be low, and you can likely just stay the course. But if that S word disappears from the text, it is time to batten down the hatches. Watch for the yield curve to flatten or invert and the VIX to spike. That's your signal to get defensive and protect your portfolio from a potential storm.
So the next time the FOMC minutes are released, you won't just be a passive observer reading the headlines. Nope, you'll be a code breaker. The clues are all there, hidden in plain sight. The Fed has laid its cards on the table. The only question left is, will you know how to play the hand you're dealt?